Good afternoon, dear clients, and welcome to Maybank's Market Monday webinar. If you're joining us for the first time, this weekly webinar focuses on the key market themes that will matter to your portfolio. My name is Seng Yeow, and I'm covering for Thilan Wickramasinghe, who is away for 2 weeks. Despite markets starting last week on concerns of a super upbeat non-farm payrolls data, US inflation remained elevated in September, and then the October 7 brazen attack on Israel really disrupted things. The 10-year US Treasury yields backed off from 4.8% to 4.6%. Fortunately, this helped stock markets bounce up a little bit. The S&P 500, in summary then, ended the week up 0.45%. Dow ended about 0.8%, while the Nasdaq fell 0.18%. You might ask why this strange phenomena when there's still so much noise in the background. Well, the answer lies in the view that the Fed may now be finally pivoting, as evidenced by bond markets on the long end adjusting upwards. With 10-year treasuries now approaching 5%, this has led the Federal Reserve officials to officially acknowledge that markets could now actually be doing some of the legwork to cool the economy. This means also that it will leave less need for additional monetary policy tightening for the Fed. So with interest rates in focus, this week we are going to start the webinar by focusing on two sectors, Singapore REITs and banks. My next guest speaker is Krishna, who heads the REITs research for Singapore. Krishna, a higher for longer interest rate environment is not good for the S-REIT sector because cap rates and the debt profile could impact valuation and DPUs. Can you give us a breakdown of the various asset classes and your top picks? Krishna?
Okay, thank you. Sorry for that. Yes, Seng Yeow, you really started on a topical point. The higher debt cost impacts the overall sector, and I think our clients are not unaware of this thing. We are seeing the debt cost rising up at a varying pace for all the subsectors. Obviously, the industrial and the hospitality sector are relatively immune. We all know that the hospitality sector has been able to raise the room rates to a record level, which is increasing their top line revenue and therefore able to offset some of the debt cost. But that said, the next leg of growth is very much contingent upon the continued growth of tourist arrivals, which we are seeing some patchy numbers of late. And then partly also because the tourist arrivals from China are a bit slow to pick up. For the industrial sector, the sector has been able to ride the tailwinds of the pandemic, but those tailwinds are receding. However, because the asset sizes are relatively smaller, they have been able to sell some of the lower yielding assets and invest the proceeds into higher yielding assets or compensate for any distribution losses through those divestments. So those two sectors have been able to offset to some extent the higher funding cost. However, the commercial sector still remains in some form of difficulty there, and we are seeing some recycling of capital. But by and large, I will say that it is still not sufficient enough to offset the debt cost. So in this chart, what I have done is we have basically taken the top 4 REITs across subsectors. So you have Capital and Integrated and Mapletree Pan Asia, which are the commercial ones, Ascendus for the industrial, and then Capital and Ascot for the hospitality sector. And all that I have done is basically looked at their change in the funding cost from December 2021, till June 2023, which is where the span of the whole funding cost increases. And then compared that increase in funding cost versus how their property yields, the net property yields have changed. On an average, you can see that debt cost is up by about 60 basis points, but property yields are up by about only 25 basis points. This is despite the rents have increased, the room rates for the hospitality sector have increased, and so on and so forth. So we can see there is still more downside to your asset valuation. And further, we can also say that the whole debt stack for these REITs have also not repriced. So longer the Fed holds these rates, the higher the debt cost will increase, and asset values have to correspondingly adjust, or the REITs have to further increase the rents. So I think it is suffice to say that the full impact of higher debt cost and asset values have not yet been reflected in the financial numbers as of now. So if you can just quickly move to the next chart. How about the REIT prices? I mean, have they adjusted enough? And this is where I am comparing the dividend yields of the REIT, that is the REIT index, versus what you get in the Singapore 10-year government sector bond. That is the chart on your left. And the chart on your right is comparing the Singapore REIT yields versus what you get in the investment grade corporate bonds of Singapore. So as you can see, for both of them, the yield spread that you are getting versus historical norms have not yet adjusted. So you are getting about 320 basis points spread for the versus your government sector, and then versus your investment grade bond, you are getting only about 200 basis points. So if you can see, the REIT prices have not yet come off enough to compensate for the risks that you are taking. So both on the valuation side as well on the on the correction of the asset values itself, on the book value itself, the REIT sector has still not adjusted for the higher debt cost. So relatively, yes, the industrial and hospitality are better, but still we would say that if you want to play in the sector, it is better to stick with the large cap liquid names. In our recent note, we have suggested Maple Tree Logistics Trust and CapitaLand Integrated Commercial Trust as the two names. And again, we will reiterate the risks are to the downside for the sector. Seng Yeow, those who stop on this one.
Thank you so much for those insights, Krishna.
Thank you.
I'm now going to turn my focus onto the bank sector. Singapore Banks will be reporting between the last week of October right through the 10th of November. As Thilan is not available to participate in today's show, we've asked him to pre-record a session on what to expect from banks in the third Q earnings season.
Hi everyone, it's Singapore Banks results season coming up again. Third quarter results for UOB will be out on the 26th of October, DBS on the 6th of November, and OCBC on the 10th of November. Now, what can we expect from these results? For one thing, on a quarter-on-quarter basis, we are looking for overall earnings to start slowing down, much like what we saw in the second quarter. On a year-on-year basis, given a low base, things should still be up, but on a quarter-on-quarter basis, things will be slowing down. There are three things that we'll be looking out for. The first is on net interest income. We will start to see that coming off, partly because of loan growth, which is weak, especially with China's reopening not going as well as what we expected it to go. Plus, a lot of Chinese onshore customers actually have the opportunity to borrow cheaper locally than in the international markets. So apart from that, though, net interest margins for these banks, those should actually be flat to slightly better. Remember, the Fed increased interest rates by 25 basis points back in July, so that will help with their loan yields. And overall, deposit competition for these banks have generally been quite disciplined. So we should still see net interest margins holding up a lot better. On the non-interest income side, though, it's a little bit of a different story. We should see more slowdown in growth, particularly for fee income. We've been expecting, or we've been hoping to see wealth management coming back, and that hasn't happened for the first half. And we think it probably hasn't happened for the third quarter as well. Interest rates are too high for a lot of customers to take on additional risks. So I think wealth management fees will be quite weak. Trading income should be okay, but again, probably not as strong as what we saw in the second quarter, given that the yield curve has been moving up. So that's something to watch out for. Now, good news is that asset quality should actually still be quite benign. We saw NPL ratios continue to fall in the first quarter and the second quarter, and that probably will continue in the third quarter, but you might start to see management giving out a lot more cautious guidance in terms of asset quality going into 2024, as well as most likely putting in a little bit more cautious provisions, particularly general provisions in the third quarter as well. So all this means that it's going to be a slow quarter for the Singapore banks. We don't expect any major dividend announcements in third quarter. That's not very seasonal. But we think in general, guidance for dividends would be quite positive, especially with Basel IV being implemented for a lot of these banks. Their CET1 ratios will actually go up, at least initially in 2024. So that will free up a lot more capital for them to give out as dividend. So overall, we are keeping a neutral rating on the banks as we go into the third quarter. We think UOB has a slight chance of surprising on the upside, given their exposure to a lot more to ASEAN, as well as the integration of their Citi consumer business. But some of that might be lost because of a very strong Sing dollar, so translation impact will come in. But overall, for the banking space in Singapore, DBS remains our top pick. Thank you.
Okay, thanks for that, Thilan. So for some of you who might be interested in reading up more on this, on the banking sector, you can actually get the report from your sales representatives or download the report from the Maybank Trade app under Market Insights. Okay. So there again, here we have Thilan's top pick for the bank sector. It is DBS. I'd like to move on now to the to Hong Kong, China. As you know, China just basically completed its Golden Week, and here to walk us through in terms of some of the tourism and Macau activity, we have Sonia, who's basically a Hong Kong portfolio strategist, joining us for this webinar. So Sonia, can I hand this over to you to talk us through some of the highlights that you've observed for the Macau gaming market?
Oh, sure. Thank you. Thanks for having me today. And here is the slide that showing you that for the visiting arrival and also for the tourist number for different, to the different country during the Golden Week period, we observed that actually for the overall travel numbers actually is slightly missed our house's expectation in terms of the tourist number and also for the revenue. And the reason is that for the flight capacity issue, for the left-hand side, actually you can see that the flight capacity from China to several countries actually didn't resume in a very good spaces. So you can see that for Hong Kong, Singapore, actually the flight capacity have already resumed more than 70%, but for other countries, actually around 50%. So we believe that the major reason that for the domestic travel numbers and also for the revenue terms miss our expectation is one of the reasons. But we do see that actually we observed two numbers. Actually, their interest to go travel is very high in China. But so you can see that for the Hong Kong and Macau, and because for the flight capacity, they resume in a very good number, so that you can see that the outbound flight booking from China to Hong Kong and also to Macau actually growth even have already exceeded for the 2019 levels. So that we believe that for the Golden Week, we saw that for the visiting arrival to Macau actually record a very good number, even better than the official expectation. So going for the next slide. This is what we highlight during for the Golden Week period. We observed that for the Macau, they have already welcomed more than 932,000 visiting arrival to Macau during for the whole Golden Week period. And for the daily visiting arrival is more than 116,000. And for the Macau government, the expectation is around 100,000. So already over more near 20%. And also compared with the peak COVID level, so around 2019 level, it already reached around 83%. So also is a very good number versus for the May Golden Week the period. And also not only for the visiting arrival, but also we will look at for the gross gaming revenue. We observed that for the gross gaming revenue, actually the numbers also quite inspiring, because for the daily average gaming revenue, they already achieved around 80 to 81% of their pre-COVID levels. And so that we believe that for the strong recovery in GGR is still be on track. And for the overall, for the market, they believe that for the Sands, China, and Galaxy will be outperformed because they have a relatively large hotel inventory, so that when there is a rebound in the visiting arrival, they can absorb all the visitation. But for our topics on this sector, we were focusing on this relatively not small cap, but I think this one is mid to large cap, is the MGM China. Of course, for the hotel inventory, this is smaller than the one that I mentioned, Sands and also Galaxy. But we like this name on two reasons. One is that for the valuations, the company actually now is trading around 8.7 times a forward EV over EBITDA. It is trading one standard deviation below its historical mean, and also compared with the for the industry average is more than 11 times. So it is trading below its historical mean, and also compared with the in the industry peers. And also, this is the company that this is the only casino operator to be granted around 200 new gaming tables when it under its recent award for the 10 years gaming license. So we believe that for the other companies, actually they didn't have allocate to the new gaming table, but MGM China, they get around 200 tables. So we believe that for the upcoming months or upcoming quarters, actually MGM China can gain more market share in terms of the, especially for the mass segment. So we believe that the market may be underestimate for its potential EBITDA growth. So for the overall Macau gaming, we highlight MGM China will be our topics.
Thanks, Sonia, for that. So as a summary in terms of all the fundamental calls that we've just made, our top picks for this week are four: Mapletree Logistics Trust, Capital Land Integrated Commercial Trust, DBS Bank, and MGM China. Okay. All right. Let us now kind of go to the technical highlights right now. We have the privilege of having Nick Eason joining us this morning. Nick's basically a regional chartist for Maybank, and I'd like to basically have him talk us through ST Engineering's chart. As you know, in a climate like we are facing at this moment, where oil price seems to be up and there's a lot of conflict, ST Engineering tends to come into play in cycles like that. So without further ado, can I invite Nick to share some of his views, please? Nick?
Thank you, Seng Yeow. Thank you for having me today. So, okay, the ST Engineering is one of the stock that we highlight in our regional strategy almanac back in 21st August. The stock actually hit our first target of gaining about 5.3% as per last week. So one of the reasons why we highlight the stock, if you look back on the October last year, the structure of the stock has changed significantly, particularly when you see series of high-low structure since October last year, and that is actually prolonged up into this year. Now, the key level that we be on the lookout is actually within at 3.8 Sing dollar, which the major resistance has been taken out much earlier August. So the moment this level has been taken out, this level, previous resistance, now turning into kind of support. So this support has been validated. As you can see, this level have been tested a number of times after they make a breakout on the early August. So the reason why we highlight the stock at the first time is because the new high structure that being created, and we expect the uptrend to continue. Now, despite the slower or the gradual growth or the upward movement, you can see that the stock is pretty much being a solid baseline right above the purple line there that represent by the 50-day moving average. the new baseline that we seen, you can see multiple rejection that the buyer keep coming in within this particular level 3.80 until last week breakout move, a solid gap until last Thursday has effectively created a new high structure that was backed by higher trading volume. Now we also looking the positive reading on both from MACD and the RSI as well, suggesting that the ongoing trend is set to accelerate further. So we believe the current what we call that trend structure to be more positive. Hence, we actually reiterating our technical buy on today's region strategy almanac as we revise the support or stop loss level higher at 3.77, while we introducing a new and higher target at 4.17 and 4.42 Sing dollar.
Thanks very much, Nick. Nick, since you're on the line, can I also ask you verbally, what's your view on the oil prices based on charts?
Brent oil, I think last week we have a presentation about oil price. We expecting the oil to pick up a pace. I think in terms of the trend is actually has been changing after I think back in August the oil price has created break above the $85 barrel. I'm talking about Brent now. Now despite the sharp decline earlier for the past few weeks, we've seen a support actually emerge again at within $85 which is also coincide with the 200-day moving average. So as per last week gain, we think there's a room for further upside. If you switch back into much more bigger time frame, looking on the weekly chart, the oil price seem to be have more room for further upside. I'm looking at beyond I think $95 with the target is actually could be reaching up to 104 to 105 $. That's for medium to long term target for the oil price.
Okay, thanks very much, Nick. So we'll leave it here. The war is, the last I checked, the tanks are still outside of Gaza, but it's going to be a very, very turbulent week. So, if you have any further questions about some of the ideas that we mentioned in the program today, please feel free to reach out to your sales reps or look up the research from the Maybank Trade Mobile application under Market Insight. So with that, we thank you so much for your time this morning, and we wish you happy hunting for this week. Thank you.